Welcome to LaTour Retirement Talk. I'm your co-host, Tony Shore. I am excited to be here today because I'm looking at two of my favorite people right now, and that is Jim Margraf and Josh LaTour. We've got the team back together. We're putting the band back together for today's show. It just Jim and I did it for a while, and the reason I'm so glad you're back, Josh, because you were gone for a couple of weeks. Jim and I were actually running out of things to tease you about.
Right.
And
I knew that was going to be it.
we gave you a really hard time while you were gone. We tried to come up with things to tell the viewers and listeners about you and complain about the fact that you were gone. And it was so long, and it seemed like we were doing that for so many shows, it actually got old to me, making fun of you, openly mocking you while you were gone.
Hopefully you got it all out of your system.
Apparently not, right? Obviously not. Obviously not. And I'm sure Jim will still be good for a few parting shots here today.
Yeah. You can't just let him go. You've got to give him a hard time when he spends. He's gone for a couple of weeks skiing.
Yeah. Well, our editor who edits the shows, once in a while, when the rare occasion where I make a mistake, he has to edit it out, or there's a glitch in the recording, or the computer. But he said it was one of the saddest moments he's ever heard during a show. And it was almost, he didn't use the word pathetic, but it was just such a sad, almost pathetic sounding when Jim was like, well, I have a one of my biggest bucket list items in the whole world is to go to Park City, Utah and ski Park City. It's a dream of mine. He just kind of went on about how it's a dream of his. It's his number one bucket list item. And I'm like, and that's where Josh is right now. Yeah. And you're here, you're holding down the fort working while Josh is living your dream. And I love Andy's like, I almost teared up.
Well, I was trying to get some sympathy from everybody.
You got some sympathy. Andy felt very sympathetic. I'm sure a lot of our listeners did as well.
Well, Jim, if it helps, I was there for the worst February snowpack in the last 150 years.
Yeah.
So you didn't miss too much.
Yeah, I heard the snow wasn't too good there. Well, hey, guys, let's jump into our show for today because I know you've got a big one. What are we talking about?
So today we're talking about, some tax strategies that can save you money. And here's the thing, Tony, when we're looking at putting together a financial plan, you're not going to have a good plan unless it takes in some tax strategies.
Right.
Because here's the thing, you can make a lot of money and you can have a lot of money put out, saved up in those IRAs. But, it's not about how much you make or how much you have. It's really about how much you get to keep. Because, we've got this silent controlling partner out there on our IRAs, our 401ks, those tax deferred accounts. And his name is Uncle Sam, and he likes to take a big chunk of things.
Right.
And so what we want to talk about today are some of the different strategies that we can use to reduce some of what he takes and at least get him out of our back pocket. And, this first one we're going to talk about here, we want to talk about Roth conversions. Mm-hmm. And, I don't know about you, but, I like the idea of being out of debt. I talk to a lot of our clients, a lot of prospects, people in the area here. They love the idea of being out of debt. But what about the funds that you have in your 401k and your IRA that you put aside? It's tax deferred. You realize you have a debt to the IRS. Inside every IRA is an IOU to the IRS. And so, when we think about this, we want to look at getting our Uncle Sam out of our back pocket for our retirement years.
Well, and I love that. Say that one more time. And that line about inside the IRA is a debt.
Inside every IRA is an IOU to the IRS.
Yep.
That's a great way of putting it. I really like that. So you have to be careful. A lot of people don't realize that, and I think
Mhm.
again, and I've said this before. I used to think this way. Well, when I'm in retirement, I'm not worried about taxes. I'll be in
Right.
such a low tax bracket. I won't
Mhm.
have to pay any taxes because I won't be earning that income. I won't have that paycheck.
Right.
But
Well,
I've been saving for retirement and I
mhm.
am going to have a paycheck. Otherwise, how am I going to live? I have to pay my bills. There has to be
Right.
income in retirement, and they still tax income even in retirement.
Yes,
They
they do.
they ta
Retirees don't
yeah, they
get away tax free.
No, they don't. I mean, we think about those funds in our 401ks and our IRAs. And, if you've been saving in those things for 30, 40 years, you think about it since 2009, we have had the stock market has been on a great run. Yes, we had a couple years that interrupted it. 2018, 2022 were negative. But for the most part, the stock market has increased significantly. And that's affected our 401ks.
Yep.
So
Yeah.
people, and when we're going to pull those funds out of there, even the required minimum distributions that we have to pull out are putting us into the next tax bracket. So what can we do to save on those taxes throughout our retirement years? And
Yeah.
this is a great one.
Yeah, and there's a lot of people that think, well, I'm not really going to be touching my IRA dollars. I'm pretty much going to leave that to the
Right.
next generation. Well, the thing is, you
Mhm.
are going to have to touch those IRA dollars, regardless of whether or not you want to. There are required minimum distributions, and just like Jim mentioned, that can throw you into a next higher tax bracket. So, regardless
Mhm.
of whether you think I'm going to be in a lower tax bracket because I'm not touching this money anyway, not so fast.
Right.
You may have to. At age 73, eventually it'll be age 75, but currently it's age 73. You're going to have to start tapping in to those IRA dollars and giving the IRS their portion.
I sat my last appointment last night. Uh, Sat down. Lady had turned 73, and she's like, "You mean I have to? Uh, I don't want this. I don't need it. Can't I just leave it?" I'm like, it's an IRS rule. If we don't do it, they're going to take a portion of it. She's, "Oh, well, give it to me then."
Yeah. Yeah.
So yeah, it's an IRS rule. We have to take those required minimum distributions.
And
But
you have to
here's
pay taxes on them.
Right.
it comes that whatever that dollar amount that we have to take, it gets added to our income, and then now we pay taxes on it. So that's why we want to look at this idea of a Roth conversion. And here's the big question out there: is it right for everybody to do a Roth conversion? You're never going to hear us say it's right for everybody. I think it's right for everybody to look at, have a discussion, and run the numbers. Does it make sense for me? But should everybody do it? No. Okay. But should a lot of people look at it? And, I think everybody should at least look at it. And, especially for those that are younger, the younger you are, the more sense it makes. What is your time frame? And there's a lot of things that we can go into. We won't have time on the show to do, but there's a lot of things to look at when we're figuring out, should I or should I not do that Roth conversion?
And many
Yeah.
times when you're going to do a Roth conversion, you're not going to convert all the pre-tax funds that you have all
Right.
at once.
Mhm.
That's going to throw you into potentially the highest tax bracket, or at least, a few brackets up, and you're going to be paying more than you need to on those dollars. So having a plan, and that's something that Jim and I do for our clients, we put together a plan over a number of years converting these dollars, because you do have a problem in those accounts. You have a debt to the IRS, and we want to help eliminate that debt. And so we got to have a plan to do that. So it's a debt consolidation plan, if you will. So yeah, so basically what you're wanting to do is put together a plan to incrementally pay these taxes over time. Maybe it's a 5-year or a 7-year plan to get this debt out of your pre-tax accounts. So that's exactly what we do.
Yeah.
And
There you go.
And Josh, I've run a hypothetical scenario
Mhm.
on someone that just had a $500,000 IRA, right? And so if we leave it there and we have to start taking those RMDs at age 73, and then we, when we're gone, it passes to our spouse, figuring, someone lives to maybe age 90, and then it passes to the beneficiaries, the kids, and they have a 10-year window then,
Right.
right? So what does the tax burden look like on a $500,000 IRA? And this is a surprising number. When I ran the calculation, I was actually surprised at it. $430,000 in lifetime taxes on
Crazy.
that IRA.
Wow.
Now that was I had to go back and run it again. I was like, no way, I made a mistake somewhere. No, I came up with the same number again. So when you look at it, from 73 to age 90, then passing on to the kids, they're paying the taxes over the 10 years that they are able to leave it in there before they have to take it all out. $430,000 in taxes. Now, think about this. Let's do a Roth conversion instead, Tony.
Mhm.
All right. Let's do it over 5 years. And let's say that you are into the 22% tax bracket. Okay. So we're not talking about someone that's down in the 12. We're talking about someone that's up in the 22% tax bracket. We're looking at $130,000 in taxes on that $500,000 IRA.
Wow.
So if you leave it there, you're going to send Uncle Sam an extra $300,000
Ouch.
in taxes.
Optional taxes.
It's optional. You don't have to do it.
Wow. Yeah. And why wouldn't you take advantage of that? And really, again, it comes down to, you got to do the math. And that's where you guys come in. You help people see the big picture.
Yeah.
They're just sitting there looking at 1,000 puzzle pieces in front of them. But what are they missing? The most important piece of a puzzle, the box lid. And you guys are saying, here's the box lid. Here's what it's going to look like. And that's the only way you're going to know which piece goes where. And taxes are a huge piece of the puzzle in retirement, as you've been saying. So most people I know, Jim and Josh, have 401ks. All their retirement money is in a 401k. The majority of people I know.
Yeah.
Some of them are smart enough or fortunate enough to also have IRAs, or maybe they have some direct stock or market investments. But it's all there. Typically, it is all in a tax deferred account, either a standard 401k or a standard IRA. The majority of Gen Xers who are headed for retirement and the baby boomers, 401ks, IRAs, all taxable, 100% taxable at your full tax rate in retirement. And that's not necessarily good. You got to get some of that money over into a tax-free bucket. Is that what you're saying?
That's exactly what we're saying, Tony.
Yeah.
Yep, absolutely. And it's a problem across the country because for so long, 401ks didn't even have a Roth option. Now the vast majority of 401ks have a Roth option, so your contributions can go into that tax-free bucket. But used to be that wasn't the case. So now we've been talking about Roth conversions, and that's a strategy that I think should be explored by everybody. It's not for everybody, but it's worth at least a conversation. Now, this second strategy we have to talk about, it's a little bit more niche. It's not going to affect everybody. It's called NUA, or net unrealized appreciation. And Tony, this is for people who have a 401k and they have company stock inside that 401k that's done very well. It's highly appreciated. They've worked there for years, so they bought it at a low cost basis, and then it's had years to grow, and it's done very, very well. We've had clients from a number of different companies that have had this exact thing, and it's something that can help them out so much from a tax standpoint. So basically, I don't want to get too far into the weeds here, but I at least want to talk about it a little bit. Basically, what happens when you roll those funds out, basically you roll the company stock out into a non-qualified brokerage account. You're going to end up paying taxes on the cost basis. So only what you paid for the stock, that's going to be ordinary income taxes. Now, the rest of the stock is held as long-term capital gains. So when you go to sell that stock over time, you probably aren't going to want to sell. If you have a lot of stock, you're not going to sell it all at one time. But if you sell it over time, you're going to pay long-term capital gains rates, which are much more favorable than ordinary income. The max long-term capital gains rate is 20%, as opposed to 37% for ordinary income. So way more favorable. And the other thing that this has helped some of our clients do is retire a bit earlier. When you have your IRA funds, you can't access those without a penalty until 59 and a half. But if you do an NUA transaction and you have this company stock, you can access that before 59 and a half. So if you wanted to retire at 55,
Sure.
you could roll that out and you have access to some of those funds that were in your 401k. Now they're non-qualified and you don't have an IRS tax penalty.
So, Josh, you said something there that I just want to point out because you went through it. And you pay taxes on the cost basis,
Right.
not how much it's grown to, not the the $1 million. It may be. Well, I think our best was like someone had a $50,000 cost basis, and so they only had to pay taxes on $50,000 when they rolled that out of there.
Right.
I forget how much that they had. I don't know if you remember, but
It was
on that
close
one,
to 1.5 million.
yeah, that's right. So that was, I mean, you think about, would you rather pay on, when we're talking about this, would you rather pay taxes on the 1.5 million at ordinary income rates or $50,000?
Right.
And so,
Right.
I mean, it's a no brainer. I mean,
Yeah.
you sit down, you look at this and you're like, yeah, let's do this. So there are some rules that are very nitpicky, I'll say.
Yeah.
I mean, we get it. This is one of those things where we get into the weeds with this. We go through it, we lay it out, and we go over it again together before we get to dealing with it with a client to make sure that every I is dotted and T is crossed on this one, because you have to get it right. This is not one you want to do on your own.
Yeah.
But when in doing this, what a tax savings.
Yep. Yeah. So one of the big rules of doing this is when you do an NUA transaction, your 401k has to be emptied by the end of the year. As long.
Mm-hmm.
So if you're going to continue working there, you're not going to do this.
Right.
That's not going to be an option because you want to be able to contribute to your 401k.
Right.
It's going to be a red flag for the IRS. You don't want to do that.
Okay.
So you're going to be retiring from that company in order to do this. So some of the triggering events to be able to do an NUA transaction would be turning age 59 and a half, retiring from the company, or death. So it's not really going to help you out a whole lot if you end up passing away, but it can help out family members.
Yeah,
Right.
your family. It can
It'll
help
help 'em
out
out.
your family.
Sure.
Yep.
Yeah.
So again, like Jim said, highly encourage you to speak with your advisor before doing anything like this because it's complicated. There are pitfalls, and I don't want you to run into a situation where you have the whole chunk being taxable because you did something wrong.
Yeah.
Because that's exactly what happens if you mess this up. Is the whole thing is taxed at ordinary income tax rates.
Right.
And like, the one example that we have here with the client that had the $1.5 million, that would have all suddenly switched over from long-term capital gains to ordinary income rates. And that's just a disaster at $1.5 million.
Yeah. Yeah, that's huge. So the NUA is an interesting one, and I think for some people in certain situations, it's a great option. But again, you need to be working with a trusted financial services professional like
Absolutely.
yourselves and the team there at LaTour to make sure it's the right thing for you. Correct?
You do. And, I'm going to put something out there because, one of the things that we do as advisors, we're always looking to learn as much as we can to help our clients. And one of the resources that we have used is called Ed Slott and Company. And he is the country's #1 IRA expert out there. Okay. And he goes through all of this. And we had him come and speak at an event here in last year. And he made a point when he was speaking, and it's not one that I knew. Because he goes through all of the laws, all of the rules when it comes to these IRAs. And he made a point in saying that there's only about 1% of advisors that sit down and take the time to go through all of these IRA rules.
Right.
And this is something that we do at least twice a year at his events. And we have a test afterwards that we've got to take, and going through all of this. And this is going through all these rules. It can really hurt you. I mean, we just had an event where we went to for his. We had a 400-page manual that we went through, and we brought it home, and it's there as a reference, plus the entire his entire team. And so, going through knowing these rules and having even a resource like them where they spend their time in the rules day in and day out
In the tax code.
in the U.S. tax code. It's amazing. It's an amazing what we can do to help people save on their taxes.
Yeah, there are some powerful things you guys are able to do to help people minimize that tax burden in
Yes.
retirement, especially if you've saved a lot for retirement and
Mhm.
you've got Social Security on top of it. Maybe you have a pension, you have these different
Yep.
streams of income, or you've saved all this money up and it's in an IRA or in the market and you want to
Right.
pass it along to loved ones. You don't want to take it out and have to pay taxes on
No.
it. So
No.
Right.
it's great to have that tax-free bucket. And I know you've talked a lot about Roths as being another solution
Mhm.
for tax-free income in retirement. And
Right.
you mentioned that earlier about how,
Mhm.
why not convert it now, pay the $100,000 in taxes versus the 400 and some $1,000.
Right.
Why give
Right.
the IRS an extra 300 grand? That's crazy,
It
right?
is.
Tony, you mentioned something about passing those funds on, and there's a lot of people that's their goal.
Yep.
Back in 2020, the Secure Act was passed, and honestly, it made IRAs a terrible vehicle to pass funds on to the next generation.
Right.
Right.
Now they have a 10-year rule where they have to take those funds out and pay taxes on them. It used to be before 2020, if you inherited an IRA, you could stretch required minimum distributions over your life expectancy. And
Mhm.
so you could end up having a multi-generational vehicle that passes on and can help,
Yeah.
fund people's lives that way. No longer is that the case.
Right.
So the Roth IRA is now even more attractive as a means of passing funds on to the next generation because
Mhm.
they're not going to have any taxes. They still have a 10-year rule. They have to take those funds out within 10 years, but they can let it sit there for 10 years and grow tax-free and then take all those funds out without paying any taxes on them. So it makes it way more favorable for your kids. And what better, love letter to your children than to take that tax burden away from them when you pass.
Yep.
Yeah.
Yeah.
You don't want to leave your loved ones in a bad situation or just, what you're passing on shouldn't be a burden and it shouldn't be something that's going to get tied up.
Right.
You want to be able to have them have access to
Right.
as much of that as possible and
Mhm.
you're not leaving Uncle Sam should not be a beneficiary. Right.
No.
Right. I mean,
Right.
your estate plan shouldn't be, I want to take care of Uncle Sam. He's been such a good uncle to me. I don't even think he's your real uncle.
I don't
Nope.
believe so.
No.
Uncle Sam and Aunt Irma. I mean, I love my aunts and uncles, but there's always that one mean aunt, the mean
There's always-
Aunt Irma and Uncle Sam. I don't think
Right.
they deserve the money.
No. There's one other thing I want to bring up when it comes to tax savings here. And this one, we mentioned, the Roth IRA is something everybody should at least look at. Josh talked about, we were talking about the NUA here. That's more of a niche. And this one's even a smaller niche.
Yeah.
Okay. So this is a smaller group of people. This one here applies to business owners. If you are, you're getting ready to retire and you're selling your business and you've got a considerable profit that you're going to be making on this business in the sale, and you're essentially using the business sale to fund your retirement. If you get that, $1 million, $5 million, $10 million, whatever that number is from the sale of that business, and you get paid that check all at one time, again, we run into a very significant taxable event.
Right.
Okay. So there is something that can be done to minimize those taxes and spread the taxes on those profits out over a longer period of time, bring us down into lower tax bracket so that it makes sense for us. And this is something that's called a structured installment sale. And what it's going to do is we're going to transfer ownership of the business into a trust so that the trust receives the money and then it gets paid out to me over time. Okay. It's going to enable me to, we just talked about Uncle Sam and Aunt Irma. If you're selling that business and you're in your 60s and now you're going on Medicare and you get this very large influx of funds from the sale, well, it's going to put you into those highest Medicare expense categories. So
Right.
we don't want to do that. But when we roll this out, we move the whole thing into a trust, we can stretch out the income from that over a very long period of time. And even if we need to delay it, we can delay the income for some time as well.
Right.
But it is a huge help just to structure that. Now, if I just have a business that I made a couple $100,000 on, it might not make sense because setting up this is a little bit expensive. But if I've got that larger profit coming in from the sale of a business, this is something that can literally save us a huge amount of tax funds over our lifetime, over the rest of our life, saving on those. It is amazing what a structured installment sale can do for us.
One of the other things that I don't think you mentioned that it can do is, if you were to just sell the business all in 1 year,
Right.
you would have a decent chunk going to the IRS.
Right.
What this can do, because you're doing it over time, what would have gone to the IRS in the first year can be invested,
Sure.
growing for you.
Yep.
Over a 5-year period where you're slowly getting the proceeds from this.
Yeah.
So
5 years, 10 years.
Yeah.
And the thing is that these trusts can be renegotiated over time to have that extended even further. So it is an amazing tool for that business owner that has a lot of profit from the sale of a business.
That's huge. And I know you have business owners that are or clients that are business owners. And so this is something that you do to help them. That's fantastic. Now we're out of time for today's show. It was great. Is there anything else you want to add for our listeners before we go today?
Well, listeners, I'd just tell you, if you're interested in some of these tax saving strategies, give us a call. Our number is 417-641-3497, and go check out our website at LaTourAsset.com.
All right. Sounds great. And that does it for today's episode of LaTour Retirement Talk with our hosts, Jim Margraf and Josh LaTour.